From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, and welcome to the COB. It's an absolute pleasure to be here with you on this Monday afternoon. If you are wondering what's been happening on the market today, or if you're listening to this in podcast form, well, we've picked ourselves up off the mat, a little bit of buying heading into the close. That's the CIBO Australia Index up by about, not up, that's red on the screen there. That's down by about 0.1%. We'll be keeping our eye trained on the S&P ASX 200, and I'll bring you the final figure there in just a few moments. So it was a bit of a Monday meltdown. We were just chatting in the newsroom about the weather here in Sydney as well, not doing anything to inspire joy, but at least we saw a melt up toward the close. Now, one of the dynamics that we've been paying attention to today is, a very sort of volatile session on Asian markets. Why? Well, we still do have some of that political uncertainty happening in South Korea, but more so, we had inflation reads coming from China, and they disappointed. So consumer prices fell a surprisingly large 0.6% in November, so pulling annual inflation down to just 0.2%. So this means that the government's attempts to stimulate the economy, specifically the consumer side of the economy, really hasn't been gaining much traction. So there's now calls for more drastic policy stimulus. Keep in mind that the Beijing Central Economic Work Conference is being held this week. Policymakers are expected to chart the course for the country's economy in 2025. So we will see. Markets are a little bit on the fence as to whether or not any further stimulus will be announced at that conference. But yeah, clearly not all is well in the Chinese economy. And then, of course, we've got tension when it comes to the oil price. Not only, real concerns about waning global demand, but also with some of the tensions in the Middle East. With all of that being said, we've got oil just sort of edging up on some of those Mideast tensions. It really hasn't shot a rocket up the energy space, and that takes us nicely to the sectors here. So energy here locally, negative, fairly negative. Beach Energy off by close to 5%. Strike Energy was actually on today's episode of The Call with Jonathan Takadina from MPC Markets and Grady Wolf from Bell Direct. You'd have to listen to that program to get their verdict on Strike Energy. Okay, the big miners down, all of them on the screen right now. Fortescue, the worst performer, down by 1.7% to $19.23. And utilities, a little bit more, positivity here overall. But look, nothing really to write home about. Origin up by about 0.4%. Sector-wise, 6 of the 11 sectors were lower today. ANZ in the news. Market not responding well to its announcement of a new chief executive. Former HSBC Wealth and Personal Banking Chief Executive Nuno Matos has been appointed to succeed Shayne Elliott on July the 3rd. He's retiring after 9 years in the role. Platinum Asset Management tumbling. Regal ending its buyout talks with no new deal reached. Life 360 dropped as well. Queries about the stock's inclusion in the Russell indices after it said that it had recalculated some index weightings, down by close to 8%. GQG Partners did have a great day. It reported higher funds under management, says that it's terminating a buyback due to uncertainty of U.S. tax treatment. And Superloop rose after it announced it would buy Uecom from Optus for $17.5 million. That was the stock of the day. I'll get there in just a moment. I'd like first, though, to chat with Mark Gardner from MPC Markets about, about the day that was? Nothing too great.
It's a little bit like the weather. It's a bit meh.
Yeah.
So
could have been worse, but
yeah, absolutely. I mean, those material stocks started off the day a hell of a lot worse and sort of rebounded over the course of the day. It'd be interesting to see what comes out of China. Overall, at that
conference,
the conference that they're talking about.
We're going to call it the conference.
Yeah. So and realistically, we've had these reactions before where the data comes out, the market falls, but then it very quickly turns into optimism about, well, they're going to have to stimulate.
Yeah.
So, and it may force their hand, a little bit, having that pretty horrible inflation number. So some of the manufacturing data and services data has been mildly expansionary. So I think we're probably through the worst of it, and a little bit, I think it would be appropriate for a little bit more stimulus to be pushed through. Obviously, the consumer targeted thing's not working, but they're sort of trying new things with the stimulus and trying to be a little bit more targeted. So some of them are going to work, some of them aren't going to work. But I think, instead of using that blunt force bazooka style stimulus, I think targeting is a far more prudent plan for the central banks. I think it'll end up with more sustainable growth rather than quick flash in the pan money that tends to get a bit wasted.
I just think that energy sector at 12-week lows. And I just find that surprising. I mean, yes, we've got oil prices struggling for direction. The demand picture is not looking crash hot, particularly if you take China into the equation. But still, with all of the instability in the Middle East, you would have thought it would perform better today.
You would absolutely have thought it would perform better. I think it's become a little bit of white noise. Materials and energy are the two probably the worst performing sectors this year. And we went through a bit of obviously in preparation for outlook for next year, went through sectors, and obviously IT and financials have been the two better sectors this year. But they do quite often, coming off a bad year, you do so. Materials was one of the better performing sectors last year, and obviously, but one of the laggards this year. Financials was the worst sector last year.
Thank you, big banks. Yeah.
And then this year is one of the best. I think we had the same situation where industrials 2 years ago were the worst sector by a long, long way. I think it nearly halved, and then James Hardie had that incredible year, and the likes of Brambles, etc. So. You do tend to see on a 2 year basis things start to even out a little bit. The tech sector really is the only one over the last 3 years. Obviously, 2022 was down 37%, and then it jumped 17% last year, and then something like 68% this year. So that's really the only outlier where it's really kicked along. But I would say that overall that resources sector is looking very attractive. Tech is looking probably somewhat overvalued in terms of they're going to have to really hit such super high targets that the market's set with current prices, and the banks as well. We get around to earnings season, there is just no way the big four banks can will hit anything that justifies those share prices, and we'll just see if that super money that just keeps flowing into those big four banks sort of starts to potentially dry up a little bit. Obviously, we had the kick up in the amount of super this year. Index ETFs have been, had massive inflows as well. That sort of out of whack valuations will tend to correct over time. So
So what you're saying is don't necessarily expect tech to repeat its performance from 2024.
But like I said, back to back, it was 17% into 68%. That's quite impressive. I mean, it is a very small sector, and it is dominated by a very small amount of really high quality players. But I would say, the resources sector, and the energy sector, which has been under the pump pretty badly for the last couple of years. I mean, things can't necessarily get much worse. I wouldn't have thought. Underlying commodities haven't nosedived anywhere near as badly as the companies have. But I think it's just that the point that really raised for me is that flow of money. Basically, if your sector's out of favour. And IT's been the big winner this year globally across the board. The AI thematic that sucks the capital out of the other sectors. And when when that thematic starts to peter out a little bit, they'll go hunting for other options again. And obviously those unloved sectors will probably prove to be high on the list because there'll be such good value in the following years. So it's a really good time of year to be just having a look through your portfolio, maybe addressing, because particularly in that tech sector, you would have, if you've owned Pro Medicus and WiseTech and Technology One, I mean, rebalance is going to be necessary at absolute bare minimum. So then you're going to have to go. You don't have to sell out of those stocks, but you might go and trim some of them, reweight. You've got to go looking for other options. So and I think that's where that this sort of time of year will be when people start to review those portfolios and maybe start to make those shifts.
All right, so that's something to put on the to-do list, I guess, ahead of your Christmas shopping. I don't know. It's feeling all very, downward spiral to Christmas, isn't it, these days?
It is very much so. So particularly in our household.
Yeah.
So,
my computer's going to die. We do, though, have a lot of data, even here locally. So we've got the RBA tomorrow. We've got jobs on Thursday. What's really exciting you about either or?
Not necessarily Australia. We probably just don't want a massively hawkish tone. Although the consumer has been spending, retail sales numbers have been fairly resilient. So whether the RBA feels the need to maybe wave a bit of a stick, but I don't think so. I don't think that they don't meet again until February, basically. Then US CPI is probably the big risk this week. Michelle Bowman came out over the weekend and was basically saying, inflation's not under control here, and they've got a 90% chance of a 25 rate cut on the 17th and 18th for the FOMC meeting. I think they won't cut, and I agree. I agree with Chair Bowman that basically we've had fairly resilient numbers, and I think the rhetoric from analysts over since Friday's payrolls number is just ridiculous. They still had 230,000 jobs. Yes, the unemployment rate went up from 4.1 to 4.2, but I think they're really they're wishing so much for a rate cut. They're looking for any reason, and 4.2% unemployment rate is like a dream for just about any government or central bank for the last 100 years. It is absolutely no justification for any sort of rate cut. I think they'll hold, and I think they'll probably wait and see what Trump actually does in the new year. So we may, it's an outside bet really, but I think they may even wait till the February meeting just to see how things play out, because if he does go through the tariffs, they are going to have an inflation. In the short term, they're going to have an inflation problem on their hands. So, there's no point going and aggressively cutting really, really quickly, and then having to potentially unwind it, very, very quickly as well.
Well, interesting. I mean, we were chatting with Andrew Ticehurst from Nomura today. He's betting on a February rate cut coming through here. So, really interesting. That interview's up online if anybody would like to have listened to his reasoning.
Yeah, I would say zero chance of that happening. But it's that's what makes a market, I guess.
Yeah.
And things can turn really quickly. But as it stands at the moment, I think we've discussed this before. People were really smart with their with their energy rebates and things, put them on their mortgage. So I don't think the economy is going to nosedive necessarily here, and I think everyone's really not putting enough weight on the fact that we didn't go as hard as everyone else.
Yep.
So Bank of Canada and ECB are expected to go 25 and 50 this week.
But they've got a real slowing economy in Canada.
Those two actually genuinely justify a cut.
Okay, so inflation in the US. Do you think that's going to justify a cut in?
I'm more worried about if there's a slightly higher print. I think that's really going to put the brakes on any sort of
the rally.
Anything below, I think really they're already pricing in 90% chance anyway. So I think a lower number does nothing. I think a higher number rattles the market a little bit, and we are sitting at pretty primo valuations as it stands over there. But and I think if we do see a lower print, you probably see a little bit more of a broadening of that rally over there, where you might see the Mag 7 maybe drift a little bit, and that money switch into the smaller caps overall if it's a lower print. But I don't see the market necessarily from an index point of view moving particularly. It actually might look like a down move because of the concentration in the Mag 7, but the broader market actually might see some positivity. So,
look, we will see. Thank you so much for wrapping the day, giving us your thoughts and chatting sectors with us as usual, Mark. Appreciate it. Okay, let's get to the stock of the day. Superloop was it. Grady Wolf from Bell Direct and Mark's mate, Jonathan Takadina from MPC Markets.
So I do actually put a buy rating on the company. They've done really well to acquire this, announce this new acquisition today, and we're expecting a lot from the company over the next year. So I do like the company. They've reiterated guidance recently as well at their AGM, which we've seen a lot of companies have reduced guidance in this current tough economic environment in the market. So for them to keep it and maintain it is really good as well. So yeah, I really like the company and it's a buy.
Yeah, I'm in agreement with Grady. Very positive. I have a buy recommendation as well, so I'll get that out there. Management's kicking goals. If they're reiterating guidance and doing acquisitions growth by growth, I think they're kicking more goals. So yeah, it's a buy. They've definitely outperformed the telecom sector. I mean, the telecom sector's up 6% year to date. Superloop's up 240%. So
yeah, there you go.
That's a good outperformance, and I think that continues.
Both the buys. So there were many double buys on today's episode of The Call. I can't remember having so many companies that both the guests thought are worth a buy. So I really hope you check it out. You can do that online, ausbiz.com.au, or yes, in podcast form. Let's get across some of these market leaders. And Goodman Group, one of the best performers. No news that I can see, nor for Genesis Minerals. Audinate's been beaten up lately, so a bit of an uptick there. But also Auckland and EVT. So companies we don't usually see on this leading or board of leaders, at least by percentage terms. On the flip side, though, Alcoa was down by 5.6%, so pretty negative there. Perth Site Basin, some news coming out from Beach saw its share price down by close to 5%. And the Star Entertainment Group, boy, down by another 4%, 19 cents per share. In the small to mid-cap space, MoneyMe hit the $4 billion in origination mark, and the shares have responded up by 17%. Tivan, I said I have a call in with a company. I haven't heard back from them, to be honest. I'll give them another call. But yeah, they got some government money on Friday, an announcement of that. And yeah, just a lot of investor interest in it right now in that critical minerals space. Impedimid, AI Media Technologies up by 9%, and Reef Casino Trust flipping the page. And some of those laggards, Calix did an institutional placement. It's down by 12%. And Amario International off by 9% to 31 cents per share. Tonight, it's pretty quiet, but as I mentioned, we've got a very busy week to come, including CPI in the United States, as Mark Gardner was just talking about. We get consumer inflation expectations for the month of November and also wholesale inventories for October in the United States. And tomorrow we'll have all the interest rate stuff covered here on AusBiz. So at 2:30, we've got a cracker of a panel lined up. Really looking forward to that one. And then we'll follow it up with Michelle Bullock's, her media conference that she holds now after each and every meeting. So yeah, those board members met today. It's a 2-day meeting, and they will announce their decision come 2:30 tomorrow. So, where'd the market finish? That's a good question. That's the CIBO Australia Index down by about 0.1%. So pretty mixed picture for the sectors by the end of the session. And then the S&P ASX 200 to start this 5-day trading week, ended mildly positive. So we had some buying into the close, 8,423. Relatively flat finish, but it is green on my screen, a gain of 0.02%. So there you have it. Could have been much worse. Markets in China still coming under a lot of pressure after that disappointing data coming through there. The E-minis in the United States, S&P 500 and NASDAQ also coming under pressure. All right, tomorrow we'll get you across the interest rate decision. Look forward to that. We'll see you. We're live from 9:45.